Most beginners don't lose money buying bad coins, they lose it because they keep buying dips that aren't bottoms. Every dump looks like opportunity. Cheap price, easy bounce, perfect entry, so they buy. Then the market keeps falling. And that smart dip becomes another trapped trade. ByteCrypto Labs tested this pattern across Bitcoin and Ethereum, and the results were ugly. We started with the most common beginner move. Buy after roughly an 8% drop from recent highs, allow a much deeper loss and exit after a short rebound, or exit after 30 days no matter what. No indicators, no confirmation, just the pure "this looks cheap now" entry. Then we ran that exact behavior 26 different times in real market conditions from the start of 2025 through 2026, and at first it didn't even look terrible. The win rate stayed around 60%, which sounds decent until you look at the account. Trade after trade, entry after entry, and almost no real progress. Across both assets, the strategy finished basically flat. That was the first warning. Winning often did not mean entering well, and we ask, what if the problem isn't buying dips? What if the problem is buying them too early? So we ran a second test. Same 8% drop, 30-day window, but this time there was no instant entry. We only entered after 3 things happened. RSI dropped into deep oversold territory, momentum started turning upward, and price printed a rebound candle. Then we tightened the stop to 10% and aimed for a cleaner 18% move. In short, no buying just because it looked cheap. We waited for the selling to slow down first, and that changed the behavior fast. The data showed it immediately. The filtered version triggered only 8 trades, less than a third of the beginner entries, but drawdowns got slashed. On Bitcoin, account damage dropped from over 5% to under 2%, and on Ethereum, it was cut almost in half. Returns were not explosive, but the random pain was gone. That was the second warning. More dip buys were not creating more opportunity, they were creating more exposure. The dip alone was never the signal. The real mistake was buying too early. Beginners bought the first red move. The filtered test waited for the selling to slow down. That small delay changed everything. Fewer bad trades, smaller drawdowns, less damage. And that's the trap most people never notice. Crypto can look cheap and still keep getting cheaper. So if your only reason to enter is price is down, you're not timing a reversal, you're just reacting, and reacting is expensive. Now, RSI was only one way to filter this. There are other ways to test dip timing too. Trend structure breaks, volume reversals, higher time frame support reactions, and some of those may be even stronger. ByteCrypto Labs is testing those next. But this first experiment already proves one thing: buying every dip keeps you busy, waiting keeps you safer. So before you buy the next obvious discount, ask, am I buying weakness, or am I buying the first proof that weakness is ending? That one question can save you a lot of dead trades. If you want the exact chart examples and full backtest setup, check the description. Now tell us in the comments, what coin gave you your worst dip buy disaster? We'll use the most painful real examples in the next ByteCrypto Labs breakdown. Subscribe for the next filter tests. Master crypto one byte at a time.